Hello students, welcome to EPG Pathshala. I am Dr. Manjeet Singh from University School of Applied Management, Punjabi University, Patiala. Today, we are going to discuss about a module on the topic Financial Market Environment under the paper Business Environment. Now, after completing this module, what we are going to learn? Firstly, the objective of this module is to introduce with the various types of investors and their investment objectives. Secondly, to identify the components of financial market environment. Thirdly, we will be in a position to describe that how the components of financial market environment are integrated. And lastly, you will be in a position to explain that how financial market environment has become internationalized. Financial deals bring two different identities together, wherein one side has a party that has shortage of funds, and on the other side there is a party which has surplus funds. Fund seekers want to get liquid funds and are willing to pay the cost for it, whereas the fund investors have wished to channelize their savings in the most optimal way so that they may earn maximum return on it. Financial markets have an important role to play in this financial environment. Financial market introduces the borrower and the supplier together so that the investment objectives of both can be met. Financial environment emerges when different individuals and institutional investors enter in this market with different investment objectives. Investors are generally categorized in three different types depending upon their willingness to assume risk. First is the aggressive investors. These are the investors who wish to take maximum risk with the objective to earn more return. Second is the extreme opposite to this. The other one is the conservative investors who wish to take the lowest degree of risk and are satisfied with the minimum return. And within these two extremes lies a balanced investors who will prefer to take calculated risk and will like to get return higher than the risk-free return. Investors are an important building block of the financial environment. However, this is most diversified component as investors plan to invest with a different investment objectives. Investment objectives of the investors may include tax planning, capital appreciation, enhanced liquidity, assured return, long-term return, and so forth. These investors prefer to select different financial products, that is, the different financial instruments based on these varied investment objectives. And selection of these financial products is also affected by investor decision to select a particular combination of assumed risk level and preferred return. Components of financial environment. The complete system of financial environment comprises of four important components. These include number one, financial managers, number two, investors, number three, financial markets, and number four, financial instruments. The financial managers. Financial managers are responsible for taking decision on acquiring the funds for the business and appropriately investing those funds. The actions taken by financial managers to make financial decisions for their respective firms are referred to as financial management or managerial finance. Financial managers are expected to make financial decisions in such a way so as to optimize risk-return trade-off, so as to ensure maximum value of the firm and ultimately maximizing the value of the firm's stock price. Hence, the final focus of finance manager is to take financial decisions in a way that may ensure maximum wealth to the shareholders. Financing decisions by financial managers. One of the important decisions to be taken by the finance manager is to arrange required funds for the business needs. However, while procuring these funds for the firm, he has an option to arrange it either through debt financing or through equity financing. In debt financing, borrowed funds are used to finance investments in the projects. For example, firm can obtain loans or can issue debt securities, which are certificates representing credit provided to the firm by the securities purchaser. In case of arranging funds through equity financing, required funds are arranged by offering ownership in the firm to the investors. Further, these funds are used to finance investments in projects. Financing decisions by financial managers. In case of arranging funds through equity financing, firms have option to either retain some of their earnings or come up with new issues like issuing of equity shares, that is stocks. These stocks are certificates representing ownership interest in the issuing firm. Selecting and deciding a balance between quantum of debt financing and equity financing is to establish linkage between short-term and long-term financing. Hence, time factor plays an important role in the decision of the firm to design their capital structure. Therefore, for a finance manager, for determining the optimal sources of financing at a given point of time is an important issue. Among the decisions to balance between debt and equity financing, a finance manager is also required to have in-depth analysis of the financing alternatives, costs associated with procuring those funds, and finally, long-run implications of this decision. Now, let us discuss the various types of investment decisions taken by the finance manager. Investment decision is among the two important decisions taken by a finance manager. Responsibility of the finance manager is to identify and assess the various investment opportunities for the business, and finally, the finance manager has to determine and decide that whether they should pursue with those opportunities or not. The investment decision of the finance manager significantly affects the long-term survival of the business, because that will determine that what type of businesses the firm should engage in. An investment decision also determines the composition of the assets found on the left-hand side of the balance sheet. The finance manager needs to take a balanced decision on investing of funds in the long-term assets as well as the short-term assets. Short-term assets to keep some funds in cash or near money assets to meet the working capital requirements of the business. Finance manager attempts to maintain an optimal level of each type of current asset such as cash, inventory, receivables, and other current assets. He is also required to decide which fixed assets, such as in which projects we should invest in, and when the existing fixed assets need to be replaced or new assets are to be purchased or disposed of, these decisions are also to be taken by the finance manager. These decisions are very crucial as they have significant effect on the firm's success in the years to come. Investors. Investors may be individuals or institutions who have surplus funds and are willing to provide these funds to the borrowers such as firms, government agencies, individuals, or other institutions. Individual investors are generally small investors who commonly provide funds to the firms by purchasing their securities, that is, equity shares or debt securities. Second category of investors includes institutional investors. The financial institutions that provide funds are referred to as institutional investors. Some of these institutions focus on providing loans, whereas others commonly purchase securities that are issued by firms. Debt financing by investors. Debt financing to firms is provided in various forms by individuals as well as institutional investors. Individual investors who wish to take least risk and want to get assured return will prefer to invest their funds in securities markets. However, financial institutions have different constraints to prefer investment in debt securities. One of the special features of financial institutions providing debt financing is that they generally invest their funds in bulk. So, for this reason, they have to maintain a separate loan division who monitors this complete process. It is worth mentioning here that main reason for the financial institution's preference to invest in debt securities is to receive compensation as periodic interest payments on the funds offered by them as loans to the borrowers. Fixed maturity periods, another feature that attracts both individual and institutional investors for debt financing. Hence, debt financing is provided for a specified maturity date at which the amount borrowed has to be paid back. In another form of debt financing, individual investors and financial institutions purchase debt securities that are issued by firms and governments. Sometimes borrowers try to attract investors by offering them dual return along with fixed interest on principal amount. They are offered some discount on its principal value so that the principal they are repaid at maturity exceed the amount they paid for the debt security. In addition to this, investors may also be lured by cumulative periodic interest payments on principal amount. Some of the debt securities have this additional feature that to ensure liquidity to the investors, they can sell these to other investors before their maturity. As a result, this borrowed amount of loan is transferred to the other investors. Equity financing by investors. Investors who have desire to get high returns than the normal risk-free return may prefer to invest in equity securities. A firm collects funds through equity financing by selling their shares of stocks to the investors. These stocks ensure ownership rights to the investors, and each investor who purchases the share becomes the owner of the firm. However, one particular feature of these securities is that there is no maturity on equity investment, but investors can ensure the liquidity of these securities by selling their shares they own to the other investors in the secondary market. So investors who invest in firms' equity get a return in the form of dividend. Equity investors also get benefited by the capital appreciation, which gets resulted through the increase in the share prices of the stocks. Financial markets. Financial markets represent a place or a market that facilitate the flow of funds among the investors and the borrowers. In financial markets, investors and borrowers trade financial securities, commodities, and other fungible items at a price determined by demand and supply. Financial markets are typically defined by having transparent pricing, basic regulations on trading, costs and fees, and market forces determining the prices of securities that trade. Hence, the financial markets refer to an organized institutional structure or a mechanism for creating and exchanging financial assets. An important component of these financial markets is financial institutions that act as intermediaries. Now let us talk about one of the very important component of the financial markets, that is capital market. This is a market segment of the financial market that facilitates the trade of long-term debt and the corporate stocks or shares. In capital markets, those securities are traded which have a maturity period of more than 1 year. Capital market is a market where the buyers and sellers trade in the financial securities like shares, bonds, debentures, etc. The buying and selling is undertaken by the participants such as individuals and the institutions. Capital market may be equity market or it may be the debt market as well, because it includes both types of securities. Second important component of the Indian financial markets is the money market. These are the markets for debt securities where short-term securities are traded. Now in the money market, only those securities are traded which have a maturity period of 1 year or less. Securities traded in the money markets are the treasury bills, the bankers' acceptances, the certificate of deposit, commercial paper, etc. Cost of money or cost of capital. Any investor who sacrifices the use of funds and invested in financial markets usually expect the borrower to pay a nominal rate of interest. Or in other words, we can say that the investor always has some expectations from the borrower. Hence, the price paid by the borrower for borrowing money is called cost of money he has arranged. In financial management terms, we also call it cost of capital. This is usually referred as a percentage rate over a period of time and reflects the rate of exchange of present consumption for future consumption. Cost of money comprises of following components. Firstly, it includes risk-free rate. The rate earned on a riskless investment, usually the government securities or the other related securities, are called as the risk-free securities. And the interest charged on that, the rate of interest on that, is called as risk-free rate. Apart from this risk-free rate, another component of this cost of money is the inflation premium. It refers to the premium resulting from the expected inflation over a period of time. As we all know that if we sacrifice funds for a certain period of time, then we are also expecting that when receive these funds in future, the value of the money will come down on account of the lesser purchasing power of money because of inflation. So, the investor who is sacrificing his funds, he expects some kind of inflation premium as well, which is added to the risk-free rate of return. Third component of this cost of money is default risk premium. This particular premium is a kind of risk associated with the default on a loan by the borrower. Another is liquidity premium, that is the premium arising due to lack of liquidity. And lastly, it also includes the maturity risk premium. This risk reflects the degree of interest rate risk that may change in over a period of time. Now, Another very important component of the financial markets is the financial instruments. Financial instruments refer to the tradable securities of financial markets. These financial instruments may represent cash, ownership interest, or contractual right to pay or receive the money. Broadly, financial instruments can be of two types. One is the cash instruments and second is the derivative instruments. Cash instruments are the one whose value is directly determined by the market, like deposits, loans, whereas the value of derivative instruments is derived from the underlying asset, such as forwards, futures, options, swaps, etc. Integration of components in the financial environment. The job of a finance manager starts as soon as a firm requires funds to meet out their financial obligations. Hence, they start looking for investors who have surplus investable funds. Hence, financial planning on the part of firm's finance manager will try to estimate how much funds the firm needs to invest in its business. At the same time, they will try to locate prospective investors from where the firm will obtain funds. Integration of financial markets have benefited both the borrowers as well as the investors by improving their access from domestic markets to international markets. In simple words, through financial markets integration, domestic investors can buy foreign assets and foreign investors can also buy the domestic assets. Further, the integration of financial markets in worldwide economy has also streamlined the complete process of financial trading. As a result, financial assets having similar risk command the same expected return regardless of location of origin of the asset. All this has become possible because of uniformity in accounting and financial standards among countries that are fully integrated into world financial markets. Financial integration is a novel phenomenon through which financial markets of global economies have come close and linked together so that investors may extend their reach to other economies. The benefits of financial market integration. The first benefit which arise from the integration of financial markets is sharing of information among financial institutions. As we know that we are living in a world where communication travels very fast, and over a period of time we have seen that exchange of information has become very quick and easier. So, out of this financial market integration, the first benefit which the investors are expected to draw is that they have access of information which are being shared by the financial institutions without much of the inhibitions. The second benefit which the investors can draw from the financial market integration is sharing of the best practices among financial institutions. When the markets get integrated, whatever practices, good practices are followed by the other financial institutions, they become public and the other financial institutions can also learn from them. So this creates a win-win situation, and that is beneficial not only for the investors but for all of the financial markets. The third benefit which we draw from the financial market integration is sharing of newly introduced technologies among the financial institutions. These days, the financial markets, the major players in the financial markets, they are ready to share the technology, and that helps to create competitiveness of the financial sector. So from this improved technology and the advanced technology front, the investors as well as the financial institutions are going to benefit, and it improves the whole of the financial markets as well. Another benefit of the financial market integration is the access of the borrowers to raise funds directly from international capital markets. Integration of financial markets that allows the investors to access the financial markets across the globe. Another benefit which we draw from the financial market integration is the designing of newly engineered financial products. These days, the financial institutions across the globe are learning from each other. The kind of innovations which are introduced, the kind of products which are introduced in the other markets, they can also be adopted with certain modification into the Indian systems as well. So, this is another benefit which the financial markets are going to draw by getting more and more innovative products in the financial markets to cater to the needs of the modern day investors. Another advantage of the financial market integration is the rapid adoption of newly engineered financial products among financial institutions in different economies. As said earlier, that because of this financial market integration, the products can be used or can be copied or can be adapted in the other economies as well. And the last benefit, last but not the least, benefit is that the cross-border capital flows have become easier. Since the markets are becoming integrated and similar types of practices are being offered in the different countries, so that gives a kind of level playing field, and the investors can benefit across the globe by transferring their funds from one country to another country. Restrictions in the financial market integration. Financial market integration is not that easy. There are certain challenges in the implementation of financial market integration. These challenges are, the first one is that still there are few imperfections in the financial markets which restrict the integration. Imperfect financial integration can stem from the inequality of the marginal rate of substitutions of the different agents. Further, besides these financial market imperfections, there are few legal restrictions that can also hinder the financial market integration. We all know that each country has got its own legal framework with regard to the cross-border flows, with regard to the financial markets. So that can be one of the challenge in integrating the financial markets across the globe. So in order to achieve financial integration in totality, there is a need to remove these restrictions pertaining to the cross-border financial institution. But we all know that it is not that easy. Every country is sovereign in its nature and they have their own compulsions. And on account of this, it's not that easy. And lastly, to have a common consent on the financial institutions to operate freely, to permit businesses to directly raise funds or borrow funds, and equity and bond investors to invest across the state line with the fewer restrictions. As I have mentioned earlier, that for proper financial markets integration, there is a need to have a uniformity in the legal systems. But we all know that the legal restrictions of the countries, if they are removed, then that can create further mess in the system. So students, let us summarize what we have learned in this module. We have learned about the various types of investors and their investment objectives. As we know that different types of investors have got different financial goals, and accordingly they have their own priorities with regard to the investments in the financial markets. Secondly, we have also identified the various components of the financial market environment, which comprises of capital market, money market, financial instruments, and so forth. And then we have also described in this particular module that how the various components of the financial environment are integrated. And lastly, we have also discussed that how the financial market environment has become internationalized.